So Tesla just released their earnings. Wall Street seems to hate the results. Tesla's short sellers are saying that the company is doomed and they're laughing their butts off, and the media is having a field day. So all hope for Tesla as a company is 100% lost. Or is it? Let's find out. What's up everyone, my name is Ale. Welcome back to my world of stocks. If you're enjoying the channel, please consider supporting it just by hitting the like button. And if you haven't already, make sure you subscribe. It really means a lot to me. But let's not waste any time. Let's dive right into the stock. Let's look at their performance and let's take a look at those horrendously disastrous earnings, and then we'll kind of transition to the second half of the video where I'll be explaining the reasons why I still remain bullish on Tesla for the long term. Okay, so as you can see here, the stock tanked by over 13% on Thursday before stabilizing a little on Friday, and so far that brings the stock down by over 31% in 2019 at a time when the market has been hitting new record highs. And even if we go back as far as 5 years ago, the stock is still trading just about flat, and they're currently down by over 40% just from their 52-week high. So any bears would definitely say that this is a horrendous performance tied to a horrible company, while any long-term minded bulls would probably argue that this is a great buying opportunity for the stock. I happen to be in favor of the latter argument, but my cost basis is still much lower than what Tesla is currently trading for, and I worked very hard to get my cost basis down to that level, so I'm not exactly eager to move it back up, but I probably will be buying more shares if the stock continues to drop, as that's just the type of investor that I am. I love buying stocks when they're going down and everyone is overly bearish, as long as my long-term thesis is still intact for the company. But why is Wall Street so bearish on Tesla? Well, the newest negativity stems from their most recent earnings that failed to meet analysts' expectations. See, Tesla reported a loss per share of $1.12 versus only 40 cents expected, while also reporting $6.35 billion in revenue versus $6.41 billion expected, which are definitely some pretty big misses, at least when compared to analyst expectations and when considering that this was a record quarter for deliveries. However, if we look at these numbers year over year, we can see that their loss per share was actually much lower than what they reported the year prior. In fact, just from a raw total standpoint, they reduced those losses by a pretty massive 62% year over year. Yes, they did miss expectations, but it's still a huge improvement, going from over $500 million loss last year to less than $200 million this year in the same quarter. And when looking at revenue, you're talking about a nearly 60% increase in sales, jumping from just $4 billion last year to over $6.3 billion this year in the same quarter. Again, that's short of expectations, but it's also a stretch for Tesla bears to say that a company that is bringing in billions of dollars in revenue and still growing at 60% is no big deal. That's a huge deal in my opinion. Now, to be fair to all the Tesla bears and short sellers, Tesla continues to struggle with GAAP profitability, with last year alone still seeing about a $1 billion loss when looking at GAAP net income. But on the bright side, Tesla did say that they are aiming for GAAP profitability in all of the following quarters, although it still remains a bigger priority to focus on volume growth, capacity expansion, and cash generation. In other words, this is a relatively new company that still needs to prioritize growth over profitability, and for that reason, many short sellers justify their positions, given that Tesla is definitely not a value stock, especially at this early stage in the game. However, I do still believe that Tesla will be sustainably profitable in the future. I just think it's going to take some time. And in the meantime, I think Tesla will remain a very high growth and pretty attractive growth stock just kind of overall. But it's one that is definitely not without its problems or without its risks. In fact, I still consider Tesla to be a little bit of a speculative stock, which is why I use the smaller speculative portion of my portfolio to invest in Tesla. But when I look at the risk reward ratio over the long term, I just think it's too attractive for me to stay out of it. And look, it's not like Tesla isn't doing everything they can to become sustainably profitable in the future. And when I hear the short sellers talk about Tesla losing money on every single vehicle, when they talk about them having negative margins, when they talk about them not having any positive cash flow, I'm honestly sick of hearing it. It's a lie, and it's a lie that I think they continue to push because they want to convince everyone that Tesla has to go bankrupt at some point and to kind of drag the stock down. But it's definitely something that I think we have to address. So let's take a look at it right now. If we take a look at CapEx spending, which is basically spending money on things like buildings and equipment and improvements and similar expenses that help you grow the business but can also be a drag on profitability, we can see that in their most recent earnings, they lowered their guidance for CapEx spending this year by 22% to just $1.75 billion at the midpoint. Now, many shorts complain that Tesla spent too much money on growing their business, and now that they're cutting back a little, my guess is that they're going to try to spin this into saying that spending less money is a sign of them not growing anymore, or there not being enough demand to warrant the higher spending. But it is what it is at this point. I just see it as an improvement to their efficiencies and being more conscious about their spending in an effort to reach profitability in the future. Speaking of which, they may not be profitable from a net income perspective, but when looking at free cash flow, Tesla isn't really doing all that bad. 3 out of their last 4 quarters were cash flow positive, which is something that we've never really seen from Tesla in the past, so it's definitely a sign of improvement. Yet all of these short sellers keep pushing this narrative about Tesla losing money on every vehicle they sell, and it's just not true. Here's a chart of their vehicle margins by quarter that completely disproves that myth. Sure, those margins have been getting weaker in recent quarters, and their free cash flow was also lower than what they saw in Q3 and Q4 of last year, despite having record deliveries this quarter, but you have to put all of this into context. The tax subsidies have been cut in half twice already this year and will disappear by the end of this year, which forces Tesla to keep prices lower in order to compensate. All the meanwhile, Tesla is spending huge amounts of money to ramp up production and deliveries, both of which just hit record highs, and on top of all of that, they're building out an entirely new gigafactory out in China, while also expanding their infrastructure of chargers and service centers, so those are gigantic expenses, yet they still came out positive this quarter. Not to mention that Tesla is currently moving away from their higher margin vehicles like the Model S and the Model X in favor of a more mass market vehicle like the Model 3 that sells for a cheaper price so that more people can afford it, and that ultimately hurts their margins. But as they scale up the Model 3 and later release the Model Y SUV along with their newer pickup truck and semi-truck as well, I think those margins will continue to improve. And if you remove their CapEx spending, their operating cash flow numbers get even larger, so there's really no reason to think that their cash flow won't get even bigger in the next 2 quarters, considering the reduction in CapEx and the seasonality of the market, which we'll take a closer look at in just a second. Not to mention that they also made some decent improvements to their balance sheet, growing their cash to $5 billion and their current assets to over $10 billion with a current ratio of above 1. Sure, they do still have a lot of long-term debt, but this is definitely not a company that is going to be going bankrupt anytime soon, which is a very aggressive narrative that Tesla shorts constantly try to push. We constantly hear them right along with the media and biased analysts say that Tesla stock is going to zero, or at least some very extremely low targets like just $10 a share. In my opinion, these people are nothing more than corrupt clowns if they think that no other company would acquire Tesla before they reach $10 a share, or that they won't be able to raise any money even though they have an insanely strong brand with unbelievable sales growth. Okay, so now that we're caught up with the financials and all of the concerns over profitability, let's go ahead and transition to their deliveries forecast for the year, because this is another thing that I constantly hear short sellers and the media push this narrative around there not being any demand for Tesla vehicles, and therefore they definitely cannot hit their forecast for the year. So let's take a look at that. Okay, so in this earnings, they reaffirmed their guidance for the year of 380,000 deliveries at the midpoint of their range, and that's an increase of 55% year over year, which is enormous. Again, nobody seems to think that they can actually hit these targets, and it's a common narrative that I see being pushed by shorts. Well, 2 things on that. Number 1 is that the Model 3 has been the best-selling car by revenue in the United States over the past 4 quarters, so the whole no demand narrative needs to die. It's a flat out lie. We know it, the shorts know it, the media knows it, yet they continue to push it. Doesn't matter if you're talking about the Toyota Corolla, the Camry, the Honda Civic, the Accord, Tesla's Model 3 beats out all of those cars, which are insanely popular vehicles to begin with, and they're not even the direct competitors to Tesla, which the Model 3 beats out all of its competitors combined. That's insane. And number two is that Tesla already did 158,000 deliveries in the first half of this year. So to reach the 380,000, they would just need around 222,000 more vehicle deliveries in the second half of this year. Sure, if Tesla has no demand and for some weird reason everyone hates Tesla vehicles right now, then yeah, that's going to be a very hard target to hit, but that's not really what's going on. Tesla sales are growing by insane percentages year over year in what is one of the most seasonal industries in the world, where the first half of the year always sees an enormous crash in sales, only to later take off like a rocket ship in the second half of the year. So if you're telling me that Tesla can't improve their deliveries from 158,000 to 222,000 in the second half of the year, again, in one of the most seasonal markets in the world, then I think that's not giving Tesla nearly enough credit. I'm not saying it's impossible to miss those targets. Anything can happen, and there could be a number of logistical issues that get in the way, especially related to China and Europe. But if you ask me for my personal opinion, I think they hit those targets and we end the year with enormous growth year over year once again. Okay, so that catches us up to where we are right now and where I kind of see them going in the short term when looking at like the next few quarters to end out the year. But as you guys know, I'm a long-term minded investor. So where do I see the company headed in the future, looking several years out? What do I think will propel this company to move forward? Let's take a look at it. Well, for starters, we have the launch of the Model Y crossover SUV, which in this latest earnings, they mentioned that they will be able to overlap a significant amount of components between the Model 3 and the newer Model Y, so that should ultimately keep their costs even lower. Again, we already knew that the Model Y was being built on the same platform as the Model 3, and there's a logical reason for that, as they now predict that the Model Y will actually be a more profitable product over the Model 3. And that makes total sense when you consider not only the cost synergies, but also the higher price of SUVs, but also the fact that SUVs are the highest selling vehicle type in the United States at almost 40% of the market, which should also lead to greater volume and help them benefit from the economies of scale. But speaking about the best selling vehicle types, coming in at number 2 are pickup trucks at over 16% of the US market. And Tesla hasn't forgotten about these customers either, as they will likely announce a new truck model later this year. We are still about a year away from seeing either of these models hit the road, and probably a little longer for the pickup, but once they do release, there should be versions that will sell for as little as around $40,000 for the Model Y SUV and around $50,000 for the pickup truck, which are very affordable prices for those type of vehicles. And again, what is the two largest categories in the United States? So there should definitely be some demand there, and it's something to definitely be bullish on. Again, over the long term. And don't forget that electric vehicle sales in the US are only 2% of the entire market, and I can't even imagine how much smaller it must be for just SUVs and trucks. So with the United States, along with China and Europe making up the biggest electric vehicle sales in the entire world, that should translate to enormous growth potential. And speaking of China and Europe, they remain well on track to locally produce the Model 3 in China by the end of this year, which will significantly improve their margins and cash flows even more, and they're even working on choosing a location for their European Gigafactory within the next few quarters. Both of these expansions are gigantic deals when you consider a report from Bloomberg that states that electric vehicles in China will grow to 8% of the market next year, 20% in 2025, and 68% in 2040 in what is again the biggest electric vehicle market in the entire world. And when looking at EV sales by countries, 5 out of the top 10 countries in the world are all European countries, so having gigafactories in the United States, China, and in Europe is again a huge deal that, in my opinion, will finally get us to that sustainable profitability that would otherwise make this speculative growth stock a decent investment option for the future. And again, when talking about profitability, you're talking about a company that is relatively new and is trying to disrupt like some of the biggest industries in the world. And a lot of these Tesla short sellers think that Tesla should just be profitable from the very beginning. It's going to take time, and they need to realize that, at least in my opinion. And that's not even talking about all their potential in the future with their robo-taxi service and their energy products and everything that they can do with all of the massive data that they collect as well. But just to sum everything up, look, I'm not trying to be overly aggressive on or towards Tesla short sellers or Tesla bears. I actually think that there are some very rational minded, some very reasonable Tesla bears out there who just genuinely disagree with the opinion of a Tesla bull like myself, and I think that's totally fine and reasonable. But for me personally, I just think that this is the future that we're headed towards. I think Tesla is ahead of everybody else, and I want to be a part of that. And I acknowledge that there are a lot of risks that go along with this stock, but again, the risk reward ratio to me seems worth it, and it's not a huge position in my portfolio, so I can definitely afford to lose all of my money in Tesla, and it really wouldn't affect me in a huge way. But if Tesla does take off, I will benefit pretty substantially from that. So again, the risk reward ratio, I'm not really putting up a lot of risk, and I still stand to benefit from a lot of reward as well. So I think it's worth it for me, and I really don't think that they'll be going bankrupt. I think that's insane. But anyway, that's just kind of how I feel about Tesla and why I believe in them in the long term. Let me know what you guys think down below. It's okay if you disagree with me. You can still leave your comments down below, and I'd love to read them and respond to them, and we can have a discussion about it too. And I think it'd be a lot of fun. But anyway, I hope you guys enjoyed the video. Thank you so much for watching. Don't forget to hit the like button, and I'll catch you guys in the next one. Take care. Bye-bye.